you know, going back to what we said, and I'm taking this here from the CEO of Fannie Mae, consumers to understand that it's unlikely we will again see the low mortgage rates we had during the COVID-19 pandemic, when a unique combination of monetary and fiscal policy sent rates near all-time lows. So once again, tied to a major event.
Yeah. So here's what I'm gonna end this with. This is Wall Street's like kind of final word on it, and this is what we need to keep in mind when it comes to interest rates. The spread, which again is the difference between rate and mortgage rates,
Keep on your 10-year treasury there.
could remain around the 2.5 percentage point range because the Fed no longer supports the mortgage market as it has done during QE. So how is the Fed supporting the mortgage market? They were feeding money into the mortgage market by buying mortgage-backed securities.
Mm-hmm.
So all of those mortgages are bundled together in those securities, and the investors and the banks that are making those loans are selling those loans essentially to the federal government and getting cash in return that they can then lend out, continue lending out for more mortgages. They're not doing that anymore.
No.
There's no basically free, zero interest. Remember, that money's going to them zero interest. No interest. Basically free money to those banks to loan out, and the banks are making fees and some points off of it every time they do a mortgage. That's done. So they got to use their own money, or they got to borrow money from other big banks, and those big banks are not giving it away for free. There's got to be a differential between that, so that they're not going to give you the money for free. They got to make some money. So it's doing the opposite. It's letting its holdings of MBS, mortgage-backed securities, run off at the pace of the pass-through principal payments. So this is the people who are paying their mortgages. There are servicers out there that are collecting those funds and passing that through on those securities to the owner of the security, which in this case is the federal government. They are letting that run off. And the Fed said repeatedly that it would let the entirety of its balance sheet, they want all the MBS to run entirely off its balance sheet, even after quantitative tightening ends, and they're going to replace those mortgage-backed securities with treasury securities.
If you keep reading, you're going to upset people.
I know, likely with T-bills, and here's where it's going to hit.
Here's the thing.
Which would take years, and it would keep the spread wider, all of which will put upward pressure on mortgage rates.
Upward pressure on mortgage rates.
Upward pressure on mortgage rates. Yeah, we do. Yeah, technical difficulties, it happens. So we're stuck with this. And the longer you wait to buy a home, the higher the price is going to be. So saying I'm going to wait a year, and the price goes up 20 grand, and now you're financing an extra 20 grand.